We're often asked about what we think about the macro environment surrounding credit today. Well, we look at it in two ways. One is technical, and on the technical side, there's no doubt that people continue to need yield both here and abroad. And that's causing tremendous fund flows into credit as people seek to obtain income. That's a very positive situation for spreads, and one that's absolutely supportive of the Palmer Square product suite as we continue to see spreads tighten in many areas in which we invest on behalf of clients. The other area that you have to think about from a credit macro perspective is, of course, fundamentals. Fundamentals are incredibly positive today. And what's most unique about it is 2020 produced a lot of the strength that we see today in that companies were forced to refinance, bolster liquidity, even if they didn't need it. Many companies cut costs because it was so uncertain coming out of March 2020 and all that COVID brought. Finally, a lot of companies also were very innovative about growth, top line growth. So when you look at defaults, we continue to believe they're going to remain very low. And again, that's very positive for spreads, very positive for credit, very positive for the areas in which we operate. Now, the difficulty though is valuations are at high levels. So you've got a great technical backdrop, you've got a great fundamental backdrop, but you've got to be selective in the areas in which you choose to invest, because the reality is many areas of credit are trading at their tightest levels over the last 10 years, literally last 10 years. So areas like CLO debt, CLO equity, bank loans, company-specific high yield, the Palmer Square mandates that we operate are flexible, and we can move our capital into those types of areas, which today still offer really compelling risk return.